This is Horizons Middle East and Africa. Our top stories this morning. Production halt. Nvidia reportedly asks suppliers, including Samsung, to stop work on its H20 AI chip after Beijing urged local firms to avoid using it. Caution dominates markets as signs of U.S. economic strength have traders trimming bets on Fed rate cuts ahead of Jay Powell's Jackson Hole speech. And Israeli Prime Minister Benjamin Netanyahu is weighing his Gaza City military plans while leaving room for a deal to bring back all remaining hostages. It's just gone past 8 a.m. across the Emirates, 6 a.m. here in Johannesburg. I'm Jennifer Zabasaja in for Jumana Bersechi. And as we've been speaking about all week, the focus is squarely on Jay Powell's Jackson Hole speech coming later today from Wyoming. Markets have been relatively cautious ahead of that speech, really because many market participants wondering what exactly we're going to get from Jay Powell, especially as we have continued to see pressure from the White House to bring cuts into the fold. So let's just take a look at where markets are positioned ahead of the trading day. NASDAQ futures marginally down right now, though largely flat right now. As we were mentioning, caution really taking shape within the markets. U.S. equity futures flat across the board, though that coming after we did see a down day for the tech-heavy NASDAQ. And also, as we were mentioning there, focus is taking shape with the news of Nvidia ordering that suspension of chip production. And of course, we are waiting for Nvidia earnings that will come next week. Bitcoin also in focus, tracking largely strengthening relatively, at least to start this Friday, up about 0.4% there. Although we have seen Bitcoin and Ether ETFs logging 4 straight sessions of outflows, with investors actually pulling a net $1.9 billion. Though Bitcoin, as we were mentioning, has pulled back quite substantially from the highs that we did see last week. Bitcoin trading at about 112,000 there. The U.S. 10-year yield, of course, in focus as we await those comments from Fed Chair Jerome Powell. Right now, the 10-year yield at 4.3257 there. And we have Brent crude on the board as well. Slightly weaker on the day, though, shaping up for its first weekly gain in about 3 weeks on those potential progress talks that we did start the week off between Russia and Ukraine, potentially setting up ceasefire talks in the next few weeks. And as we brought to you yesterday, a drawdown in U.S. inventories. Brent crude right now trading at about $67.56 a barrel there. But let's check in on how markets in Asia are faring. Min Min Lo has been watching it from our Hong Kong studio. Min Min, what are you watching?
Hey, Jen. Yes, markets are a little bit on edge today as we look towards Jackson Hole. You can see the Asia Pacific benchmark trading sideways today, but the Kospi is leading gains ahead of the first ever U.S.-South Korean summit happening next week. So we're seeing foreign inflows into sectors like chips and shipbuilding. And here you can see the TAIEX selling off, dragged down by TSMC on the back of this news that Nvidia has been asking some of its component suppliers to halt production of the H20 chips as China expressed concerns over security issues. But flip the board, we're taking a look at how Japan is faring as well, because we got the CPI data coming out of Japan today, 3.1% on the CPI, beating estimates of 3%, but certainly still far above the BOJ's target rate of 2%. And that continues to cement the idea that the BOJ might be behind the curve when it comes to rate hikes. And here you can see a bit of a melt up in the yields here, the yen pointing weaker. It's hovering around the 1 week weakness here on the back of the pared back rate cut in the U.S. So Jackson Hole will be closely watched by investors. Yen seeing some vulnerability here.
Thanks so much, Min Min Lo in Hong Kong, for starting us off there. We'll check back in with you in just a bit. Let's turn back to our top story, though. The information has reported that Nvidia instructed suppliers, including Samsung and Amkor, to halt production of its H20 AI chip. Beijing reportedly advised companies to steer clear over security concerns for the chip built for the Chinese market. Nvidia, for its part, has repeatedly denied it builds backdoors into its product.
U.S. government, the Trump administration, has approved licenses for us to export H20s to China. Recently, China asked some questions about some security backdoors in our chips. We have made very clear and put to rest that H20 has no security backdoors.
Our chief North Asia correspondent, Stephen Engel, is joining us now for more. So, Stephen, surprising news coming from the company, especially a few days before their earnings. Give us a sense of what we know at this point.
Well, obviously, this has been quite a seesaw story because the H20 was originally designed to adhere to those export controls from the U.S. administrations to China. So the H20 is a more scaled down AI accelerator from the current Blackwell. And then, of course, the Trump administration essentially banned it to go to China in April. Then there was that high profile meeting in the White House between Jensen Huang and Trump in July. They got it back, allowing those export licenses for the H20 to China. China, by all accounts, the chip company or tech companies in China started ordering them quite in large volumes, but only recently, as you rightfully said, and also, of course, Jensen Huang just alluded to in an impromptu press conference this morning in Taipei, he said Chinese authorities essentially are starting, and regulators are essentially telling chip companies in China, don't buy the H20. So definitely a seesaw battle going on right now for Nvidia, as it used to bank quite a bit of its revenue from the China market, and that was seen as a reprieve when the H20 could go back into China. So we'll have to see how this plays out. It's definitely benefited Chinese chip companies and AI plays in China, as the Chinese authorities, whether it's the Cyberspace Administration of China, the NDRC, or the Ministry of Information, or Industry and Information Technology, have all essentially pushed Chinese domestic tech companies to rely on domestic alternatives to Nvidia because of those security backdoors. And also, let's face it, Jennifer, Chinese authorities were sort of insulted by U.S. Commerce Secretary Howard Lutnick, who essentially said on July 15th in an interview on CNBC, we don't sell our best stuff to China. We don't even sell our second best stuff to China. We don't even sell our third best stuff to China. So there's been a backlash.
How do you see this, Stephen, then affecting trade talks between the two nations?
Well, again, there's going to be ups and downs in the trade talks. So far, there's been a second extended truce. We'll have to see. Obviously, in this autumn, we're going to see likely Donald Trump coming out to Asia, whether it's on the sidelines of APEC or ASEAN or actually a state visit to China. We don't know right now, but we do know that Trump wants to meet Xi Jinping. They want to hammer out a lot of these issues. These tech controls from the United States were at the center of China's demands to relax them. Now it's China that is saying, we don't want those chips. So it's another fold in the convoluted relationship between China and the United States.
Convoluted is a great way to describe it. Thanks so much. Our chief North Asia correspondent, Stephen Engel, there on that news from Nvidia. Thanks so much, Stephen. Now, traders have pared back wagers on a Fed rate cut ahead of Chair Jerome Powell's much-anticipated speech at Jackson Hole. Bloomberg's Mike McKee has more.
The cast is in place. The Wall Street audience is watching. What we don't have yet is a script. That's Fed Chair Jay Powell's job. In his last speech here as chair, Powell is expected to lay out the parameters of the Fed's new policy framework, how they think about the decisions to raise or lower interest rates. He's also expected to touch on whether they will raise or lower interest rates at their next meeting on September 17th. Investors may be disappointed if they are expecting him to say yes. Employment has weakened and inflation has ticked up. Two developments that call for different policy responses. The chair is likely to say officials are waiting for more data to make their decision. After Powell's remarks to open the conference, attendees will dive into a series of academic discussions about the labor market of the future, how demographics, AI, and immigration will affect jobs. Investors will likely tune out that part. For them, the symposium beginning is the end. Michael McKee, Bloomberg, Jackson Hole.
Now, for more on what investors are watching out for, let's bring in Gareth Nicholson, CIO at Nomura International Wealth Management. Gareth, thanks so much for joining us. Mike McKee setting us up there really nicely heading into Friday. Give us your perspective. How are you looking into the speech from the Fed chair?
Well, Jennifer, I think it's all coming down to the one-man show, and this has been for the last year, President Trump, but now Chairman Powell's definitely taken that front seat. He will drive the narrative, the risk-on narrative, if it continues. Markets are pricing 90%. Now they've moved down to 70% chance of a rate cut in September. There's still some probability of a larger than one rate cut, larger than 25 basis points. So there is a lot of uncertainty, and we're looking for some leadership. Jerome Powell should be that leader that comes out and directs it. But to your point, there's still a lot of data between now and the meeting. You've got PMIs coming out from a number of places, which will likely suggest that the economy is strong. But from our perspective, if we look at inflation, if we look at labor markets, we think the labor market is weak enough to justify one rate cut in September, followed by another one in December and another one in March. This will align with where we think the economy is going. That will likely be a shot in the arm for risk markets, positive for risk.
You said positive for risk. We are seeing, though, investors largely sitting on the sidelines, a bit of a risk-off sentiment. Where do we start potentially to see some of this activity after the Fed chair gives his speech? Where do we start to see a bit of risk-on piling into the markets?
Well, typically, you're going to get the biggest movers down are going to see the knee-jerk reaction up. We're looking for longer term when we're looking for the risk-on metric. We still like U.S. equity, but we understand that there's many sectors that are trading particularly tight, particularly expensive. So for us, the risk on going into equities, going into private markets is a grind higher for the U.S. market. We probably think there's more beta if we do see the rate cutting in other regions. So we could see areas like China, Japan, also following suit in their equity markets with this idea that monetary conditions in the biggest economy is going to continue to remain loose. And that is our opinion at the moment, that conditions are already relatively loose for companies. Earnings are showing through very strong. And now with rate cuts on the way, that is a boost for equity markets. It's now just the point, how much higher can they get before we get a little bit of a wobble? We think it can grind higher.
Simon White, though, of our Bloomberg team, suggesting that potentially signs of a correction are impossible to ignore. Do you think we're reaching a top here with some of these equity markets?
Well, for sure. We have certain sectors which are already leading the pack. Some of the earnings dispersion is huge, with price of earnings for certain sectors above 50, and that is quite worrisome. We know the breadth of the market now. 40% is in the 40% of the market is accounted by top 10 names. That is not particularly healthy, but the market is passing through a lot of the inflation to its customers. Earnings still remain high. You still have a robust economy. So we still think that there's space for it to grind higher. The tricky bit is, as you're picking up coins in front of the train, do you want to keep doing that, or do you want to start diversifying a little bit out? We think the train has somewhere to come. So we are still preparing. We're looking outside. We think there's quite a lot of juice still left in the Japanese equity market, in the Chinese equity market. So these are spaces that we're slowly moving large overweights in US abroad.
Do you focus then on equities, Gareth, as opposed to credit?
Yeah, well, there's three main bets for the risk that we see. Like you said, equities is a grind higher. We still like that. Credit spreads are incredibly tight. They're not offering much cushion. We're going to see a lot of uncertainty around the credibility of the Fed, which means rates volatility. So I don't think you're getting paid for credit in the current environment. It's a difficult space. Prefer taking some correctly weighted equity risk and other fixed income exposure. So things like private infrastructure, private credit. There's certain sectors in there that we think offer a good risk return at the current levels.
Gareth Nicholson, CIO at Nomura International Wealth Management, joining us with your insights and analysis on this Jackson Hole Day. Gareth, thanks so much for your time. Appreciate it. Now, coming up, we turn to the Middle East. Israel's Prime Minister Benjamin Netanyahu is weighing Gaza City military plans while leaving room for a deal. We have the details on that next. This is Bloomberg. Israeli Prime Minister Benjamin Netanyahu says he has instructed negotiations to begin immediately to bring back hostages held in Gaza. Speaking during a visit to the Army's Gaza Division headquarters, Netanyahu said he will give final approval to plans to take over Gaza City and defeat Hamas. Let's now bring in Stuart Livingston-Wallace, Bloomberg's executive editor for the Middle East, North Africa, and Russia. Stuart, so we were just mentioning there, Netanyahu saying that he's pushing ahead with Gaza City takeover and also renewed ceasefire talks. How are you reading this?
So, I mean, it appears to be a continuation of the sort of the twin track approach that the government has been taking in Israel. So, on the one hand, in terms of the ceasefire negotiations, that does appear to be yet another setback on the face of it, because what Hamas agreed to earlier in the week and what had been put forward by the mediators, that is Egypt and Qatar, was a phased release over a period of weeks. And what Netanyahu seems to be asking for is the release of the hostages all at the same time. So we'll see how that develops over the next few days. I mean, it's not wholly surprising. We've seen this sort of again and again and again over the last several months, where it seems very hard to reach some sort of consensus on that. On the other hand, he does look like he's pushing ahead with this Gaza City offensive. We saw the call up of the reservists, some 60,000 of them, and then another, I think, 20,000 who will have their service extended. That's going to take several weeks, but again, it's trying to maintain that pressure on Hamas to give up more in the way of concessions in these negotiations. So it's a continuation, but at the same time, it feels like a very important moment.
And we're also seeing Israel pushing ahead on plans to expand Jewish settlements in the West Bank. We're just a few weeks out from the UNGA, where a number of countries say that they'll recognize Palestinian statehood. How does that complicate those talks?
I mean, I think it is going to make it very difficult. So, I mean, on the one hand, you have the fact that, this is an area to the east of Jerusalem, which in effect bisects the West Bank and makes it incredibly hard to come up with any sort of territorial integrity for a future state. Now, it must also be said that the West Bank was already sort of this patchwork of settlements and Palestinian areas, so it's not like, it's made things more complicated, but the complication was already there. But in terms of the international reaction, we did see a very strong statement last night from a great many countries. And again, it's that continuation, I think, of this sort of growing group of countries other than the US that are condemning these moves, not helped by these very inflammatory statements from certain members of the Israeli government in terms of, this basically puts to bed any idea that there will be a future Palestinian state. So I think that does make things very difficult at the international level. And as you say, when you have this international meeting coming up in New York in a few weeks, I think things are going to be rather difficult.
Yeah, shaping up to be some fascinating conversations, that's for sure. Stuart Livingston-Wallace, Bloomberg's executive editor for the Middle East, North Africa, and Russia, joining us there in Dubai. Thanks so much, Stuart. And coming up, with Washington pulling back, powers from across the world are stepping in to deepen ties with African countries. The details on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Africa is looking for new allies as President Trump's trade war reshapes global markets. With Washington pulling back, powers from across the world are stepping in to deepen ties. African and Japanese leaders are meeting this week in Yokohama as part of a wider global scramble for influence.
The Africa Continental Free Trade Area is central to our economic vision. South Africa seeks to deepen inter-Africa trade while becoming a continental industrial platform from which Japanese and other global firms can expand and export into our continent.
For more, let's bring in Bloomberg's Ndiro Oganga, who's joining us now from Kigali and has been following these meetings. So, Ndiro, how evident is this pursuit for new partnerships between Japan and African countries, as we've been seeing over the past few days?
Jen, it's clear as day, and if you just look at the optics, there were 20 African leaders there, leaders of big economies: Nigeria, Ghana, Kenya, South Africa, and Angola. These are people who did not want to miss the moment. They want to seize this moment. If you also look at the language that was being used, Antonio Guterres takes the stage and says, we're living at a time of interconnected crisis and deep inequality, and there's need for clear focus for development, not just for Africa, but with Africa. And that's exactly what Japan did. Their leadership pledging loans of up to $5.5 billion to come to the African continent in partnership with the African Development Bank to help tackle debt burden that has been affecting the continent. We've seen countries like Zambia, Ghana, and Ethiopia default on their debt. Kenya is struggling with the weight of repayment of its debt and has been classified as a country that is in high debt distress. And they're also looking at other things, for example, digital partnership, training people in AI, and also creating economic interconnectedness, particularly between the Pacific and the Indian Ocean. But the elephant in the room was tariff wars. You cannot ignore the fact that South Africa is carrying nearly 30% of reciprocal tariffs since they what came into effect at the beginning of the month. And the South African president himself said that it's time to find a way to diversify export markets, particularly for African countries. And he was talking about how it took South Africa 15 years to get an avocado deal with Japan, and jokingly says that if it takes another 15 years, he'll probably not be here. Also very classically highlighting the bureaucratic and structural challenges that come with negotiating trade deals. But it's not just one-sided effort. Japan is also making concerted efforts. Their companies have been trying to build businesses in Africa. In South Africa, for example, over 200 companies, 150,000 jobs.
And how does Japan then compare to other peers, other countries that are trying to do the same?
They're entering an oversaturated and highly competitive market. You look at China, biggest bilateral lender, biggest trade partner for the African continent. The Belt and Road Initiative has been a big success on the African continent. They've invested a lot of money to go into infrastructural projects like road, railway, building of dams for electricity projects. But then again, this has come with its own downside, where they've been accused of debt trapping some of these countries. We've seen Ethiopia, Angola struggle with the weight of their debt. Kenya again saying that the weight of paying Chinese debt is high. So Japan can take advantage of this and come to the African continent offering affordable loans and good partnerships.
Bloomberg's Ndiro Oganga in Kigali, Rwanda. Thanks so much, Ndiro. Now, coming up, Boeing could land a 500-jet sale to China. More on that next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. Production halt. Nvidia reportedly asked suppliers, including Samsung, to stop work on its H20 AI chip after Beijing urged local firms to avoid using it. Caution dominates markets as signs of U.S. economic strength have traders trimming bets on Fed rate cuts ahead of Jay Powell's Jackson Hole speech. And Israeli Prime Minister Benjamin Netanyahu is weighing his Gaza City military plans while leaving room for a deal to bring back all remaining hostages. It's just gone past 8:30 a.m. across the Emirates, 6:30 a.m. here in Johannesburg. I'm Jennifer Zabasaja in for Jumana Bersechi. And the Friday is here, Friday, August 22nd, which is also notable because of that Jackson Hole symposium and the speech we have been waiting for from Fed Chair Jerome Powell that is expected, that is coming later today on Friday. And investors squarely focusing in on that. Caution, as we just mentioned, still setting in on the markets as they wait and see whether or not we do get some indications of whether we'll see a rate cut in September. If we take a look at U.S. equity futures, relatively flat right now. NASDAQ 100 futures, as you can see on the board there, still flat. Although the tech-heavy NASDAQ in focus, of course, as we just indicated there, Nvidia ordering that suspension of chip production and that coming ahead of their earnings next week. So the NASDAQ in focus. Bitcoin also showing some strength ahead of Fed Chair Chair Jerome Powell's speech. But we have seen the cryptocurrencies pulling back since from their highs from over the past few weeks. Bitcoin up about 0.5% there. And we're seeing yields pull back right now as well. The U.S. 10-year yield at 4.3257 there. And of course, a lot of focus in on what we are going to hear from Fed Chair Jerome Powell, especially as he has continually felt and gotten a lot of pressure from the Trump administration to begin those rate cuts. And just finally, Brent crude on the board there, weaker on the day, ever so slightly, but still shaping up for its first weekly gain in 3 weeks on those potential progress on ceasefire talks between Ukraine and Russia, and also on a report that we got this week on U.S. inventories. Right now, Brent crude trading at $67.60 a barrel there. Let's check in, though, on how markets in Asia are faring. Min Min Lo is standing by in our Hong Kong studio. Min Min, quite a bit of green on the board there.
Yes, the market's actually largely trading sideways in Asia as we await Jackson Hole. But here in China is quite a different story. All green here. We continue to see this liquidity rally in China, and Morgan Stanley saying that this rally is likely to extend throughout the summer. But we're keeping an eye on the Hang Seng because there is a semi-annual adjustment going on today, and PopMart, that breakout star, is widely speculated to be one of the potential additions to the Hang Seng here. But flip the board, we're taking a look at some of the tech stocks across Asia because Nvidia reportedly had asked some of its component suppliers to halt production of its H20 chips. That's after China had urged local companies not to buy those chips on the back of security concerns. And what's bad for Nvidia is actually good for Chinese chip stocks. Here we can see a sea of green, up 12% on Cambricon's SMIC as well, up by 6%. Jen?
Min Min Lo in Hong Kong for us there. And we're also sticking with the story. Bloomberg has learned that Boeing is close to finalizing a deal to sell as many as 500 aircraft to China. The deal is contingent on easing trade hostilities that date back to former President Trump's first term in office. Chinese officials have already started consulting domestic airlines about how many Boeing aircraft they'll need. Let's bring back in our China correspondent, Min Min Lo, who's been following this story for us. So, Min Min, is this expected to be a centerpiece of any future trade agreements between China and the U.S.? Walk us through this.
Yes, definitely. I mean, you look at these Boeing airplanes, they are costing upwards of hundreds of millions of dollars each. And so a deal the size of about 500 airplanes, that's going to go some way to reduce the trade imbalance between U.S. and China. Certainly is going to be good for both President Xi and President Trump. The last time there was such a deal was back in 2017 when President Trump visited China the last time, and both sides had announced this agreement, China committing to buy about 300 airplanes from Boeing, costing about $37 billion. But since 2019, we had seen this sharp drop-off in the amount of orders for Boeing from China. That really coincided with the souring of ties between China and the U.S. Potentially, we are going to see a repeat of 2017 if President Xi and Trump meet before the end of the year. This could potentially anchor any trade agreement that could come out of that. We know, as you said, that Boeing is now sort of working out the terms of the deal, looking at details like delivery times and what sort of types of air jets and aircraft that China will want.
Does it get in the way, though, Min Min, of China's own ambitions for homegrown aircraft manufacturing?
Yeah, we know that China has been wanting to grow its own aircraft manufacturing sector. It has its own airplane maker as well, COMAC. And it does raise the question, right, how much of a slice of a pie does COMAC get, given that we just reported a few days ago that China is also looking at a deal with Airbus, another 500 jets that they're hoping to buy from Airbus. So together with the Boeing deal, a total of 1,000 jets that China will be wanting to buy, that would double the amount of China's aircraft right now. Of course, that's an amount that, would be very hard for China's COMAC to produce as well. The ramp up has been slow. So certainly it shows you that China is still quite reliant on Western industrial technology. But of course, a lot is very dependent on how trade tensions are resolved. This is still according to sources, and it's possible that this deal could fall apart if things don't go well between President Xi and Trump.
And that's a Bloomberg scoop there, reporting from Hong Kong. Our China correspondent, Min Min Lo. Min Min, thank you so much for that report. Now let's turn back to the markets. Emerging market currencies are falling for a sixth straight day as strong U.S. manufacturing data combined with fresh hawkish signals from the Fed weigh on expectations for rate cuts. Joining us now is Zahabia Gupta, Managing Director and Head of Emerging Markets Credit Research at S&P Global Ratings. Zahabia, thanks so much for joining us. Let's just start here with the potential for what we'll hear from Fed Chair Jerome Powell and the expectations on how that could continue to affect EM. Let's start with EM credit. What are you focusing in on?
Thank you for having me. So yes, all eyes are on Chair Powell and his comments that will come out today. Everyone's watching out for the tone that he will take about the path forward on easing in September. Actually, September is quite a crucial month for monetary policy because you have four major central banks announcing their decisions between September 11 and 19. So that's the European Central Bank, the US Fed, Bank of England, and Bank of Japan. So the banks are at different stages of monetary policy. The challenges are different. For the Fed, the main challenge is when to start resuming the rate cuts. On the one hand, you have inflation remaining above target, more upside risk to come as the tariffs kick in. On the other hand, you have labor markets that are starting to show signs of weakness. And so we think the pressure will start to form towards monetary easing. We're expecting a total of 50 basis points cuts in rates by the end of this year. Now, in terms of what does this mean for emerging markets, what we're going to see is it can have an impact on the monetary policy path for emerging markets as well, because they tend to keep a favorable differential with the major central banks and their rates. We might start to see an impact as well on bond yields for them and spreads. As well as we'll be seeing what it means for the dollar index and therefore what it means for emerging market currencies.
Can you talk about the portfolio flows that we've been seeing with EM credit over the past few months and how then that will change?
Yeah, portfolio inflows have actually been very strong since April in particular into emerging markets. And that has actually been helped by a few factors. It's been helped by very decent financing conditions, a weaker dollar from the start of the year, as well as very strong inflows that we've seen come out of Greater China. So portfolio inflows have performed quite well. The spreads have been quite narrow for emerging markets as well. And so that's also helped the borrowing costs.
What do you see then, Zahabia, as potentially the biggest risk to any of the direction of travel for some of the portfolio inflows that we've been seeing?
Yeah, the key risks are really more the indirect effects of the trade policy and the tariffs that we're seeing. I mean, while there is more certainty since the new tariffs were announced on August 1st and are effective from August 7th, there is still a lot of there are a lot of questions about what deal we'll see with China, the details of the other trade deals that have been signed, what we might see come up for specific sector tariffs as well, and the Section 232 investigations. So there are a lot of questions, and that policy uncertainty might start to have more of an impact for emerging markets, particularly when it comes to the risk-on, risk-off sentiment towards EMs and how that might affect their borrowing, as well as overall growth, because their fortunes are also linked to what we'll see happen to growth in the US and China.
Is that consistent, Zahabia, with some of the oil producers that we take a look at? In particular, I see in your report you talk about Saudi Arabia. Is that consistent with some of these other economies that you look at?
Yeah, in some ways, the oil-producing countries are going to see stronger growth. And one big reason for that is that they are increasing oil production compared to what we've seen in the last 2 years. So OPEC Plus has been releasing a lot more barrels into the markets. That is going to support the oil output and oil growth. On the non-oil side as well, we have seen very strong activity so far this year, particularly for Saudi Arabia and the UAE. So there they are benefiting from public investments, the strong push for Vision 2030 and those reforms, as well as strong activity in the real estate and financial sectors. So there is a little bit more buffer there in the economy. They also have the strong fiscal buffers to prop up economic growth.
We do have to leave it there with you, but really fascinating insights that you provided there. Zahabia Gupta, Managing Director and Head of Emerging Markets Credit Research at S&P Global Ratings, joining us there from Dubai. Thanks so much. Now, the U.S. and the EU have outlined plans that could reduce tariffs on European cars to 15% within weeks and potentially offer discounts on steel and aluminum. The joint statement also includes commitments to cooperate on economic security, food standards, and digital trade. White House trade advisor Peter Navarro credits the breakthrough in Ukraine talks for paving the way to the deal.
I can think of no deal more important than with the European Union. This is like a really important mountain to climb, and we climbed that. And President Trump got up to the top of the mountain today. In many ways, the Ukraine situation has been a total wake-up call for Europe.
And coming up, Elon Musk's SpaceX is eyeing Middle East carriers for its in-flight Wi-Fi service. The details on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Elon Musk has steadily elbowed his way into the booming market for in-flight Wi-Fi, with his Starlink service signing up blue-chip carriers from Qatar Airways to United Airlines. But Musk has his eyes on an even bigger prize: the Middle East, home to some of the most trend-setting airlines in the industry and a global connecting hub for long-haul travel. Joining us now is Leen Al-Rashtan, Bloomberg's Middle East aviation reporter in Dubai for us. So, Leen, thanks so much for joining us. Why are deals with Middle Eastern airlines so important for SpaceX's Starlink expansion, especially as we look at the breadth of how many satellites they have globally?
Hi, Jen. Yeah, these would be really huge monetary deals for SpaceX. These airlines have the biggest fleets in the world, and each installation would cost a few $100,000, and then you have to pay this monthly fee on top of it for every seat. So these could be hundreds of millions in cash for SpaceX and Starlink. Also, these airlines, like you said, they're trendsetters. They've been pioneers in first class and business product, and usually when Emirates or Qatar Airways does something, it turns out to be successful, and in a few years, a lot of the airlines globally tend to adopt a lot of these offerings and products. So this could mean more airlines, viewing Starlink as a necessity, or viewing in-flight Wi-Fi as a good product to have on board for customers.
Is Starlink seeing a lot of competition in the space in the region? Talk about what's standing in the way of potential deals.
Well, there's a few factors. A big one is, for the largest carrier, Emirates, and for sister carrier Fly Dubai, Starlink isn't authorized in the UAE. It's also not authorized for use in Iran or Russia, and these are some of the airspaces that Emirates and Fly Dubai fly through the most. There's also some of their most successful routes. China's also one of them. Emirates trying to expand there. So Starlink isn't authorized in a lot of these countries. This kind of push into the Middle East happened when Elon Musk was visiting the Middle East with Trump, and at that time Saudi authorized the use of Starlink. Now there's a rift, obviously, between Musk and Trump, and a lot of these carriers, most of these carriers are state-owned, so the politics could get in the way, and some of the state-owned sovereign wealth funds, like the Public Investment Fund in Saudi, is starting its own satellite internet company. So again, that's state-backed, and that could also prove to be a challenge for Musk.
And Leen, here in Africa, we talk about Starlink and its continued push into a number of markets. When we look at the Gulf and the push that Starlink is trying to make, What really sets it apart from some of the other players in the satellite space there?
I think they got to the game really early. They have more satellites than any other provider, so they're just faster. We've seen a few documents where maybe some of the other providers are cheaper, but Starlink really is the fastest. It's also the installation of it on an aircraft. It doesn't need any modification, not like serious modification to the airplane, and it has a catchy name. If you announce that you have a deal with Starlink, people tend to know what it is. They tend to think, oh, I want to try it on board, and they're more likely to maybe book a ticket or just know that this carrier is trying to innovate or do something new.
Yeah, and it means consistent Wi-Fi on a flight, which I think is always good for passengers. Lina Rashdan, Bloomberg's Middle East aviation reporter there in Dubai. Thanks so much, Lean, for joining us. Now, coming up, one of South Africa's biggest grocers is changing its strategy for growth. We'll bring you the details on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. South Africa's Spar Group is reshaping its growth strategy. After years of investing in overseas expansion, the supermarket operator is pulling back abroad and is freeing up capital to expand back at home. CEO Angelo Swartz told me future growth lies in a bet on high-margin sectors, challenging the country's biggest player in an increasingly competitive market. South Africa has more retail space per capita than most emerging markets. With more than 1,400 shopping malls dotted across the country, retail is big business. And in the hunt for growth, many companies have looked to overseas expansion. The Spar Group is one example. Just over a decade ago, the company acquired licenses to operate Spar-branded shops in countries including the UK, Ireland, Switzerland, and Sri Lanka. I met the CEO, Angelo Swartz, at Spar's Durban headquarters. He told me local investment restrictions were part of that motivation.
I think that idea was driven primarily by South African legislation, which limited investment managers from investing too big a part of their portfolio out of South Africa. And therefore, many investment managers were really looking for South African companies to be proxies in other markets.
Spar is largely a wholesale business. In the UK, for example, over 300 independently owned shops all carry the same brand. They benefit from centralized marketing and distribution. In exchange, the Spar Group collects fees and leverages purchasing power with suppliers. But in recent years, its African revenue has far outpaced what it gets from Europe. Take Switzerland, a country with strong trade protection measures. Groceries there are often 50% more expensive than in its European neighbors. When Swartz took over as CEO just 2 years ago, he decided to divest the Swiss and UK businesses, materially strengthening the balance sheet.
When we looked at the businesses in the UK and the business in Switzerland, is our view that those businesses are subscale, and the amount of capital that it would have to go into those businesses to get it up to scale to meet our strategic ambitions would be misplaced.
Retail analyst Alec Abraham argues Spar's biggest mistake was taking its eyes off South Africa.
When you go into a new country, there's a very different operating environment, and you need to be focused to understand that market and to succeed in that market.
Back home, Spar is expanding its DIY and pharmacy businesses and is building out its liquor operations.
And I think with Spar being where it is and how competitive the South African market is, we really just want to refocus on our home markets.
That's because liquor shops in South Africa are expanding fast. Last year, they grew almost twice as quickly in the country as conventional supermarkets.
Our liquor brand, Tops, has been around for also about 25 years. And through independent retailers, we've become the single biggest retail liquor brand in this country.
Spar's CEO has branded this battle for shoppers as South Africa's wine wars, a high-margin, high-growth area in an otherwise struggling consumer market.
We have shown that our business has the ability and our independent retailers have the ability to compete directly with the chains, empowered by us. And we are now the second biggest supermarket brand in this country, which is no mean feat.
Having sparred with what today are smaller supermarket rivals, Swartz may soon be ready to take on #1 ShopRite in what could be his toughest fight yet. And that was one of the stories we'll be covering in our monthly show, Next Africa, that airs later today. You can catch the full episode on your terminal, on Bloomberg.com, and on TV. And stay up to date with all the latest stories from across the continent by subscribing to our bi-weekly Next Africa newsletter on the terminal and our website. You can now also get the latest in audio format with our weekly podcast, available on Apple, Spotify, and wherever you usually get your podcasts. Plenty of other good content coming in that show later today. But let us take a look at where markets are positioned. We are seeing equities trading within a narrow range, of course, ahead of that much anticipated marquee event coming later today from Fed Chair Jerome Powell at Jackson Hole, and his speech hopefully giving investors some insight into the path for rate cuts in the U.S. there. But that is where we will leave it for Horizon Middle East and Africa. I'm Jennifer Zabasanja in Johannesburg. Stick with us for Daybreak Europe. That's coming up next. This is Bloomberg.